This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Oh, the tariffs have gone into effect, and the turbulence just swept right on in right there afterwards, didn't it, though?
You know what markets love? They love not knowing what live grenade is about to be thrown on the floor in front of the New York Stock Exchange.
They
it's
sure
crazy.
do, don't they? The markets just love that.
I am amazed. This was a big week. The president addressed the nation this week talking about, the time that he's already been doing things. It is amazing that not only does he want to disrupt everything, and sometimes that can be good, right? Sometimes that can be good,
sure.
But he's doing it all at the same time, all at once. And the stock market hates it. Hates it.
You are here to help us on a micro level figure out what the heck we're supposed to be doing in these circumstances. This is obviously Jon Hicks, financial advisor, founder of J. Hagan Capital. I'm Heather Branch here with Jon to ask for his insight when we have questions, as so many of us do more and more day in, day out, it seems lately. RetirementSolutionsShow.com is our website and where to go. If you want to speak with Jon and his team directly at J. Hagan Capital, we are here to help you out. Of course, links posted in the show notes as well. So turbulence, tariffs, Trump, they're all coming together. Stock markets.
Is that the three T's?
Right? Is that what's happening there? I feel like we talked about BlackRock recently, but Rick Reeder of BlackRock, he was telling CNBC the big unknown is Trump administration policy. Here's what he said.
It's been quite a ride. Like I say, a lot of this comes up because policy uncertainty is just out there. When are we going to get tariffs? What types of tariffs? What's the relationship U.S.-China? Putting all that together. Anybody who can tell you, gosh, I figured out my model on growth or inflation without a wide error band, I think is lying. You can't do it. And that's why you get these jittery markets and why risk premia has gone up.
People are lying. Wow. People are full of it. What are we to do?
When you look at implied volatility, basically, if you went to sleep, seeing, hey, right now it looks like there's green. There's positivity maybe for the market tomorrow. They called it, aftermarket iterations or whatever, right? And then by the time the market is opened and Trump has said a single word, boom, it all goes straight red because markets don't like uncertainty. And let's think about that for a minute, right? So typically stock markets go up or down based on do they think that companies are going to earn more money. So when we're talking about tariffs, and there's a whole, philosophical argument in a vacuum on are tariffs really bad or potentially good? Whatever. It has nothing to do with that. The real thing, though, is that think about it this way. How do we know if LG or Samsung are going to be positive or have growth of their stock if we have no idea if they're going to have to pay a ton of tariffs or have their profit margin cut, right? So all of a sudden, every company out there that deals with goods that don't just come from the United States, which is almost all of them,
right? They
got issues. And then on top of that, it's all of the other things that play into that. Banks absolutely got hammered this week because they're like, oh my gosh, we have all these issues. How are banks going to get these lending? How are they going to be able to make money on lending? How is this going to work out? Okay. And when you have financial institutions that take a hit, people get very squeamish, right? So from the time that Trump was elected in November of last year to now, there was a huge Trump bump. I think the market was up 4.5% or something like that after he was elected. I don't know if it was euphoria or craze or whatever it was, or maybe just a different change. The market was like, okay, now we know pro-business should be good. Maybe deregulation, maybe drill, baby drill. We'll see. But now all of a sudden what we have is all of these irons that have been putting in fireplaces. But more than that, it's like they're actually got butane fuel and gasoline. They're spraying into these fireplaces. And it's like, holy moly, the markets don't know how to respond. Now, is that going to be a big deal? It's going to be a big deal. So from that point in time, though, from the big Trump bump in November, now the market's down. It's down from the time he was elected, and it's down year to date. And it's very interesting because almost every major asset class is down except for gold. Now, gold has also been on a multi-year run up. I don't know how much room it has to grow. I still don't think that they've shown any of the live stream of what's going on in Fort Knox. There may not be any gold in Fort Knox. We don't know how that's going to work out. But interestingly enough, when you look at all these things, the markets don't like it. I think it was Bob Rubin, who was the former Treasury Secretary, said this is the most uncertainty he's seen in 62 years of his entire professional life. So the question is, how can we as investors either protect ourselves from that volatility, because volatility usually causes people to lose a lot of money. That's really what it boils down to.
Yeah.
How can we either protect ourselves from that, or how can we ride through the situation regardless of the day-to-day? How can we ride through that situation and still be able to retire when we want? Those are essentially the two major questions we have to ask ourselves.
So thinking then about, because this is, the reality is that when it comes to White House administrations, it's going to change every 48 years max.
Sure.
Knowing this is Trump's second term, and usually he only has a president in their second term. They really can only get stuff done in their first 2 years, right? And I think hence the reason why the fire hydrant thing is happening. They're racing to do stuff. You can typically
only get things done until there's a midterm election, because right now the Republicans have the House and the Senate and the executive branch. So they've got all three. So if they wanted to pass bills right now, they have a chance. Now, who knows what happens in 2 years when Congress reconvenes, and then maybe half of these Republican congressmen are gone.
Yeah.
Or maybe the Democrats get something together and they can find a way to do whatever they want to do, and they get more people in. And then it makes it more like a stalemate, right? Gridlock. And as odd as it seems that the American people and the American stock markets like gridlock, they do. They like it when major shifts can't happen any given day. And right now we have it where major shifts are potentially happening every single day.
Okay.
Right?
Yeah.
And so markets hate that. And it's really, really bad for us psychologically too, right?
Yeah.
So we've done a good job. We've set money aside. We're waiting for one day that we can have that money work for us and start sending us, a little bit of our own money back, or maybe earnings, so that we can get retired, because we want to supplement that Social Security income or our pension income or our Airbnb property, that we get money coming in. We want to be able to do that, but we don't know what the markets are going to do. So it was interesting. So this week also, Scott Bessent, who's the new Treasury Secretary, he actually said words that I didn't think I would hear in 2025. He said we may already be in a soft recession when he's actually looking at, because before he was confirmed, he hadn't taken the books. He didn't know exactly what the Treasury was showing. And he was looking at some of the numbers and he said, hey, it's not alarmist. We've been doing this, it appears now, for about the last 9 months, but we may already be in a soft recession for the past 9 months. Very interesting.
Right.
So when you kind of put those things into perspective, and I've said it on the last 2 or 3 weeks worth of shows, I've said, hey, let's just be careful. The market's been kind of expensive. And if you look at some of the Nobel Prize winners like Bob Shiller, he says, hey, based at today's prices, the market's about 35 to 40% more expensive than it should be based on fair valuations.
Okay.
And he didn't say, hey, this means it needs to come down. That's not what he said. He said, but at today's prices, we can expect the market to average about 1.6 to 2% a year. Now, guys, think about that. You have all the risk in the world of the market losing 40% in order to make a whopping 2% or something like that.
Yeah.
What are we getting on money markets right now? Like 4.5?
Okay.
Maybe a little bit higher in some situations. So the question is, are we at a place now where we have to risk a ton of money? Or does it make more sense to have hedges or safety nets or fail safes or options or derivatives or some kind of get out of jail free card? So if things do go wrong and the market does go down 30 to 40%, you're not left going, oh, crud. Now what do I do? Right? Because it's hard to retire, and it's really difficult to retire if you lose money in those first 2 to 3 years of retirement as you're pulling money out.
Right.
Because you're pulling money out that you can never have a chance to get back because you've spent it.
You spent it, yeah.
Right? So it's a big deal. So we have to be cognizant of that, because if we do have a market downturn, that's not the end of the world. If we're thinking about pulling money out and we're having a market downturn, you have to be certain that you're pulling from the right assets at the right time. Big difference.
Right. And that's where the planning comes into place.
Without question.
What is that risk called? I'm losing my terminology right now. What is it called? The risk that it is where you pull from.
Sequence of returns is
risk.
a big thing.
Yes, yes.
So even if we have a good 10-year period, it's when those returns happen. So if you retired last year was a pretty good year in the market. Last year, the market was up double digits. This year, what if you retired this year, though, and the market's down? And let's say it's down double digits. Who knows what's going to happen? I'm not saying it'll do that way. All of a sudden, you're $1 million in this example. Let's say you had $1 million and you wanted to pull out 40 grand to live off of, but you're down 10%. So you're already down. Your million is now only 900,000, and then you want to pull up 40 grand. Ooh! So mathematically, we're adding insult to injury. We're pulling out money that lost money.
Yeah.
What does that mean? It's not in there to earn it back.
Yeah.
It can't ever earn it back. So that's why, unfortunately, sequence of returns equates to almost a 30% failure chance, even if you're doing the 4% rule. So let me say that again. If you have your money invested and you're pulling income from volatile assets, like mutual funds or stocks and bonds, and we have a downturn, there is nearly a 1 in 3 chance you could fail in your retirement plan if that happens in the first couple years of your retirement, pulling out just 4%. Guys, that's really scary.
Yeah.
That's terrible. Now, here's the good piece of information.
Okay.
We can completely avoid that from happening. We can completely eliminate that from happening.
Okay.
Depending on what strategies or assets we use to pull the income from. That's it. It's not really more complicated. I call it elegant simplicity. The things that we need to produce an income, we need to get a real income from them, and we can't have them deteriorate in value, right? Because when bonds are down at the same time that treasuries are down, at the same time that stocks are down, at the same time that real estate's down, interest rates are up, all inflation's up, that is havoc, and that's where we are right now. So we have to be very careful, and we have to understand things. If we're fearful of things out there, will often do the wrong thing at the wrong time. And because we don't like having losses. No one likes it. It feels terrible, feels miserable to see the red ink on your statement. And then you see it 2 months in a row. And then you pull money out to live off of. So now you're down 3 months in a row and then down 4 months in a row. It causes a psychological effect that causes us to make dumb things happen. Or if nothing else, we just make dumb choices. We can't help it. It's just how we're wired.
Right.
So we can avoid that with the right plans for distribution plans, right? Income plans. So if you look at the biggest things we can do, number 1, protect a good portion of our money. Number 2, create an income stream. And number 3, be tax efficient. If we do those big 3 things in that exact order, we have a much better chance of having a fabulous retirement, even if we are in a recession.
Talk about kicking you when you're down, though. I mean, you're losing money to markets going down, and then you're trying to withdraw, and now sequence of returns risk comes in and just bites you in the butt.
And eggs are $10, for a dozen, and ground beef is, going to be expensive, and gasoline hasn't come down that much, and federal jobs, we potentially may have a lot fewer people that have federal jobs. So, you put all that together. Is that a recipe for some unattractive periods of time? Maybe.
But
we hope it doesn't end up that way, but we got to be prepared for it.
With all that said, volatility, despite it, uncertainty, despite it, now is not the time to just sit back and let it happen to you. Proactivity, not reactivity, is the name of the game, particularly in times of uncertainty. So if you are feeling a little unsettled about the way things have been in the last weeks and you're wondering where we're headed, of course, there's lots of question marks. Everybody knows when it comes to President Trump, you never know what's going to happen, but there are opportunities. There are ways to add layers of protection to that money you worked so hard to earn and save. Jon and his team at J. Hagan Capital here to show you what those might be within your own savings plan. So visit us at retirementsolutionshow.com to start the conversation with Jon and his team. We also have links posted in the show notes, so you can just click there, or again, it's retirementsolutionshow.com.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.